Is recording. Hi, everybody. Good morning. Thank you so much for joining us today. Canterbury Business Center gives you the welcome to our webinars. And today we have an amazing topic, financial statements. And we have a wonderful speaker, Warren Cooley. So I want to thank you for joining us. This webinar is brought to you by the Women's Business Centers of California. It's a network of 13 women business centers that have been providing services to women and entrepreneurs all over California. There's 13 centers, and as soon as we have the presentation up and on the screen, you will see the the website where you can go in and find out not only of all the locations of these women business centers, but this will give you too all the program webinars that are coming in the following weeks. These webinars are every other Wednesday, and they're all at the same time. So hopefully you will be able to join us in the future. My name again is Ruth Garcia, and I am I'm sorry, let me go back to the first slide that talks about the website. So the website of the Women Business Center is www.californiawbc.org. So that's the website that will guide you in the next webinars and will give you the locations of the Small Business Association centers through the WBCs. So again, my name is Ruth Garcia, and I was the director of an SBA Women Business Center, and our center got several awards from the SBA, so we were very happy with that. Currently, I'm the CEO of Canterbury Business Center, who is the host of these webinars. So for me, it's a pleasure to introduce Warren. Warren is a very knowledgeable professional, and he has been in many different businesses and organizations, and he has a power knowledge in this topic and many others. So please, Warren, please start the conversation with our participants.
All right. Well, good morning. It's almost afternoon, but good morning. Thank you for attending this workshop. So the title of the workshop is Financial Projections. That's the technical title. But actually what we're going to talk about primarily today is we're going to talk about financial statements. And I'm going to unpack the three primary financial statements for you, giving you a greater understanding of each one of them and what their purposes are. And then at the end, we'll have a little bit of a conversation on financial projections. So let's get this slideshow. Whoop, I don't want to do that. Let's eliminate you. All right, so the first item that we need to discuss before we kind of dive into the various financial statements is how do you prepare them? And obviously you could do old school, really old school. You could go to the Office Depot, one of the office supply stores, buy yourself a ledger book, create ledgers, right, and create forms and do it that way. None of you are going to do that. In fact, you've probably never done it before. And so the next level up from that has been spreadsheets. So we have automated spreadsheets, Google Sheets and Excel. So you could create your own. You could create your own spreadsheets, and I'll show you a couple examples of those as we go along because I want to illustrate something to you. Or the best way to do it is basically to have an automated accounting program. The most popular automated accounting program is QuickBooks, which comes in three different varieties. You can do QuickBooks Online, QuickBooks Desktop, QuickBooks Enterprise, and you can subscribe to that, so you can pay on a monthly basis for that service. And if you put in the right data as it asks you to put in, it'll spew out for you each of the financial reports that we'll talk about today at whatever time you want them to be presented. Another similar kind of a program is called Zero, and it's also will do the similar characteristics to QuickBooks, but automate your end of this conversation is you want to automate your accounting process. It makes it so much easier, and it's really not that expensive to do. So financial statements, what three are there? So you've probably heard each of these terms tossed around. You've heard about a balance sheet. I'll skip over cash flow, which is the next one listed on this slide, and go to the profit and loss statement. So you've heard of a balance sheet, you've heard of a profit and loss statement, sometimes referred to as a P&L, sometimes referred to as an income statement. And then, and those two, usually when your accountant or your CPA prepares for you financial reports at the end of a month, a quarter, a year, they will give to you, present to you, a balance sheet and a profit and loss statement. But probably one of the most critical statements that you need to operate your business on an ongoing basis is a cash flow statement. In this slide, it's referred to as a cash flow projection. The reason being is because it is a projection. It's basically cash flow as it exists today, and then cash flow presented in the future. And the reason it's important to know the cash flow is because if you don't have cash, your business is not going to be able to function. There are many stories of businesses that basically are profitable in a P&L and can't continue to operate because they ran out of cash. And I'll talk to you about how that happens as we move through the program. So let's start, let's unpack a balance sheet. Let's start with a balance sheet. So a balance sheet is, the name comes from, there's two sides to a balance sheet. There's the asset side, and there's the other side called liabilities and owner's equity. And when I say sides, it's often presented side by side. So in this particular slide that you're looking at, you see assets on one side, you see liabilities on the other side, and then the subset under liabilities is owner's equity. But it can also be presented top to bottom. So the assets could be at the top of the page, the liabilities and owner's equity at the bottom of the page. The key is that they need to balance. So you see in this particular illustration, you've got assets 10,000, equipment 25,000, inventory 20, total 55 in assets. On the liability side, you got 20,000 in liabilities, which is apparently debt, and then you've got owner's equity of 35,000, and so that totals 55,000. So let's dig a little deeper into this. So this is what a balance sheet looks like. Some of you will be familiar with balance sheets. Perhaps there's people on the line who basically have never looked at a balance sheet before. So let me just show you what a balance sheet illustrates to you. The purpose of a balance sheet is to show you the financial condition of a business at the end of a point in time. The point in time can be at the end of a month, at the end of a quarter, at the end of a year. You choose what period you want, but there's no projections in here. This is all the financial condition of the business on the day that you choose to run the report. And so this digs a little deeper than the first illustration I showed you. So you see current assets at the top. So current assets include cash, accounts receivable, inventory, for those of you who have inventory businesses, prepaid expenses. And so the total in this case is 72,425. So in each one of these categories, because they're linked, the balance sheet's linked to your P&L, your entries when you enter data into your accounting program. And so these fluctuate. Every one of these categories fluctuates as you input, as you draw down inventory or as you buy new inventory, that'll fluctuate on your, and you input that into your accounting program, that'll fluctuate on your balance sheet. So, and then there's fixed assets. So current assets and fixed assets. In this particular case, the only fixed assets that they have are real estate related. There's land, there's buildings, there's machinery. Total fixed assets of 92 or 92,575. So the total assets are $165,000. There might be assets that you have that fit in a kind of a overall collective, doesn't fit in either one of these categories, called other assets. And so that's often seen on a balance sheet. You might have current assets, fixed assets, and other, and then total assets. And then in the liabilities section, the liabilities, you see current liabilities, you see long-term debt, total liabilities, owner's equity. So let's unpack this. So in the current liabilities category, which includes accounts payable, taxes payable, other liabilities, and a current portion of long-term debt. So the intent here is that anything that in this current liability category is anything that's due within a year's period of time. So you may have a debt, for example, you may have a long-term debt, maybe 5 years. And so the amount of that debt, the principal amount of that debt that's due within the year of the date of this balance sheet would be shown as current liabilities, and then the balance due would be shown as long-term debt, long-term liabilities. And then owner's equity includes common stock. So that includes whatever you put into the business. Another way to, if you're not a stock owning kind of an enterprise and your business ownership structures uses different language than that, it's owner's investment or partner's investment. Whoever invested money, equity into the business, that's shown there. And then the last category there is retained earnings. So in this illustration, that equals $65,000. So you add all of the liabilities and owner's equity and you get $165,000, which voila, balances with the total assets in the asset column. Let me go back to something I forgot to mention under current assets. So current assets, that included there is anything that can be convertible, that will be convertible to cash within typically it's a year cycle. So within a year, if basically you anticipate collecting on an item or selling an item and converting it to cash like inventory, it's going to be shown in that column. So that's a balance sheet. So the summary, a balance sheet's purpose is basically to show you the health of your business at any particular point in time. No projection shown there, just the reality. This is kind of the reality picture of what the business looks like. And so the next statement that we're going to spend a bit of time on is called cash flow. So remember I told you that there's 3 statements. There's a balance sheet, there's a P&L. Those are 2 common statements that you'll get from your trusted advisor who sends you reports at the end of a particular period. And then the cash flow statement. And accounting programs, the financial management tools, they prepare cash flow statements for you if you put the data in properly. So cash flow statements is basically, you know, that the lifeblood of a business is money. Cash has got to flow in so that there's money there to flow out to pay the bills and for you to earn whatever you're going to earn from the business. So cash is kind of it's the food, it's the drink, it's the lifeblood, it's the blood flowing through the system of a business. And there's 3 sources of cash flow. So there's earn it. So earn it cash flow is the cash flow that you earn from operating the business. Revenue comes in, expenses are paid, and to do all that requires cash. So you earned it. There's there's money that is generated through investment. You invested money, owner's equities invested money. If you have partners or other investors in your business, they invested money. That's all invested. So that's cash that's been provided to the business for its use. And then there's borrow it. So borrow it is debt. You obtain a loan, you have a line of credit, you have a term loan, whatever the case may be, and that's how you obtain that money. And so you earn it. You get it from earning it, from investing, or from borrowing. So a cash flow statement looks at the cash flowing in and out. Now, the importance of this is relatively on the earn it part. It's relatively straightforward if your books are and your cash flow is all counted on the day that somebody paid you. So the day you create a sale, if you get paid in cash, cash includes checks, credit card, and good old green money. If you get paid in one of those three ways, the day that the item was sold or the service was delivered, then that's called cash-based accounting. And so cash flow from the business is going to be the same as shown on your operating statement, your income statement that we'll talk about subsequently. However, many of you operate a business that uses accrual-based accounting. And so accrual-based accounting is you sell an item, especially if you're a professional service business, you provide a service. At the end of the provision of that service, you submit an invoice to your client, and your client pays you 30, 60, hopefully not longer than that, but sometimes 90, even sometimes 120 days down the road. That's a whole other topic on how you manage accounts receivable. So you book, and so the sale is booked on the day that you sent your invoice out, 30th day of, how many days are in February this year? 29th day of February, you get to the end of the month, you send an invoice, and so you book the sale on that particular day. So revenue shows up as your $20,000 that you sold, service you delivered, but you don't have the cash. So you booked it then, and but you're not going to get paid for it for some time down the road. And so it's important to know when you're going to get paid, because you're accruing expenses. You've got payroll, you've got all these other expenses. So it's really important you begin to see the importance of having a good cash flow statement, so you know that when the cash is going to become available to you, and so you can manage it. You can manage it. You only have to do this a couple times and have accounts receivable late to recognize the importance of having an accounts receivable management system, so that you're on top of the money that's owed to you. And so that's basically how a cash flow projection process works. And so what can you do with it? You can it gives you an opportunity to set sales and expense goals, gives you a way to determine what your break-even point is. A break-even point, in this case, the term meaning at any particular point in time, you will know approximately how much cash you're going to have, which means this is how much money I can spend during this particular month or this particular quarter, whatever your cycle is. And it determines your cash needed to purchase inventory for seasonal cycles. So if you look at your cash flow, and this is especially critical for businesses who have seasonal. Most retail businesses fit in this category, and the seasonal tends to be the Q4, the October through December period, when many retailers, that's where they break even all the year up until that point, and that's where they make money. But in this particular case, you've got to have your inventory before you can sell it if you're a product seller. And so as you look at your cash flow statement, you may have enough money coming in that will not require you to borrow money to buy inventory, but you may not. Could be an indication as you look at your cash availability during for that particular period, that season of time, that you've got to tap into your line of credit to buy inventory. And could be new equipment that you need, whatever it is. You may have to borrow. It may indicate to you, I don't have enough cash that I earn from the business, so I've got to go borrow. I need to borrow money. I need to get invest. I need to invest some of my own new money into the business, or I may need to have investors invest money into the business. So that's those are some uses of cash flow, and some of the reasons that you need a good cash flow projection. And continuing, so how can a cash flow projection help So it tracks liquidity, as I indicated, helps you determine the need for financing. I just illustrated that to you. And if you have a history of your cash flow statements that you've prepared, and you have a current projection as you go forward, it's really important to show that to lenders, because in the lending world, when you go to borrow, one of the most important factors that a lender considers is credibility. Your credibility. How's your credit? They don't know you. So how's your credibility established? It's basically established by your previous history of operating your business in a way that's got good books, and just shows that you've got good character as you operate your business. So let's look at a sample cash flow statement. So this is so you see at the top, sources of cash, and then the columns: opening balance, month 1, month 2. So the sources of cash. So you start with the beginning cash, then cash sales. That's somebody paid you and you collected the money. Your collection on your ARs, accounts receivable. Interest income. If you have interest that you're earning from some asset that's out there, you've loaned money to people or whatever it is. Anyway, interest income. Loans received. So if you obtain financing, and then equity contribution. So remember, there's 3 sources of cash. You earned it. So cash sales and collections on A&Rs, and interest income. Those would all be earned. That's earned income. Loans received. That's debt. You borrowed it. And equity contribution, you invested it. So you see the 3 categories of cash shown there. So then operating uses of cash. And this tends to be, these operating uses of cash tend to closely reflect your operating expense chart of accounts that we'll talk about when we get to the P&L discussion. But anyway, operating uses of cash. So contract labor, wages you paid to your employees, payroll taxes, rent, phone, office supplies, utilities, travel, insurance, licenses, marketing, professional fees, other, and there may be other categories that are also important to you. But this is how you expend your money. So then there's the top total operating uses, net cash position. And then there's some non-operating uses of cash. So the operating uses of cash, remember, this is what it took you to operate your business. The non-operating uses of cash tend to be balance sheet items. They only, the recording of the use of these funds only occurs on your balance sheet. So debt service. Debt service in an operating use of cash could be, you can expense the interest part of the repayment of debt, but you can't expense the principal part of the repayment of debt. And so the debt service here, in your case, it may include both principal and interest, but I would encourage you to put your interest up here as an operating expense, primarily because you want to reduce your taxable income level to as low a level as possible, so you pay less taxes. There's a difference. There's a reason that you would do that differently. We'll talk about when we do the P&L. Equipment purchases, self-employment tax, owner's draw, and inventory purchases. So then those are all non-operating uses of cash, and then you have the ending cash position at the bottom. So that's a cash flow statement. You can create, typically if you were doing a spreadsheet format, if that's how you chose to create a cash flow statement, you can create your own, because they can come in all different shapes and sizes and forms. And if you use an accounting program, financial management tool like QuickBooks, they have a format that they use to, they've already created a template for you to use, but you can, it's not standardized like a balance sheet is standardized. Most balance sheets, they all have the same similar categories. And P&Ls, when we come to P&Ls, they can look a bit different, but they have similar categories to them, which are chart of accounts, which we'll talk about. And then just continued discussion on the cash flow projection worksheet. So to increase cash flow, the owner could. So if you looked at this sheet and the conclusion was, I need to do something. I need more cash now. What could you do to generate more cash now? These are just some illustrated, pretty simple things you can do. There's other things that are more, take more time and are a bit more complex, but this is a simple statement of 10 factors. You could increase the number of items sold. You could increase the price on the items you sell. You could reduce your expenses. You could change the timing of expenses. Instead of spending it now, spend it later. You could save money to have sufficient operating cash to get you through a ramp-up period or a startup period. You could obtain sources of cash other than sales, line of credit, for example, which we talked about. You could reduce or change the timing of the owner's draw. That's your pay. You could buy inventory from vendor at lower price. You could obtain credit from a vendor. You could establish policies to get paid sooner by your customers. This is managing your A&R. So there's a number of things you can do, but you don't know the picture until you do a cash flow statement, or in this term or in this slide they use the term cash flow projections. You don't know what your needs are until you prepare a statement to do that. And then the last one of the three, so balance sheet, cash flow statement, or cash flow projection, whatever you prefer. And then the third one is profit and loss statement, sometimes referred to as an income statement. Sometimes profit and loss is abbreviated down to just a P&L. So what does a P&L do? So it measures the revenue and expenses over a period of time. And it's again, the period of time can be a day, a week, a month, a quarter, a year, whatever period of time you choose, as long as you input the data. So you have you're timely in inputting revenue and you're timely in inputting expenses. You could get the picture just by pushing a button if you have an automated system, and see the picture, operating expense picture at any particular point in time that you wanted. And it tracks profitability, whether the business is making a profit on what it sells. It shows how successful you are at buying and selling, and it measures the ability of your business to grow, repay debt, et cetera, et cetera, et cetera. And then this is a really critical statement for you. The P&L is the most important report from your accounting software program, or if you choose to do a spreadsheet kind of a program, it doesn't really matter what you choose to do. It is the most important report that you get. And the reason being is because it's the heart of your business. Reflects the money coming in, money going out, kind of that ever going flow of the reason that you're in business. So what does a profit and loss statement look like? Well, this is a simple one, and then I'm going to show you, hopefully I still have it up on my, yeah, I do. I'm going to show you a profit and loss statement. So profit and loss statements have what are called chart of accounts. So chart of accounts are all of the account categories. If you just envision a statement, and on the left hand, let me pull something up here. So this is a profit and loss pro forma. I call it an income statement in this case, that I have included in one of a document that I've prepared, and I use in projecting revenue for people. It's projection, but so you see at the top, so gross revenue. So gross revenue, you can have various categories, whatever number of categories you want to have that you keep track of from a gross revenue standpoint. And then there's a total. Then you have cost of goods sold. So cost of goods sold, if you're a retail business, it's what it costs you to buy the items that you sold. And so this has an impact. This is tied to the inventory. And so your inventory on the balance sheet reduces as you sell items, and it increases as you put, the inventory increases as you buy new items. But cost of goods sold, a comparable for a professional service organization would be cost of doing the work, and often this isn't a category that's in professional service organizations. And the reason that they would do it is if in these categories at the top they broke it down into departments, then in the cost category down here, the direct costs, these are only direct costs, the direct costs would be that labor and those materials and supplies that are directly used to generate the revenue in this column at the top. So that's kind of an optional on whether one chooses to do their accounting that way. Anyway, you end up with a gross profit, and a gross profit is this is the amount of money you have to operate your business. And so these expenses, these are it's called a chart of accounts. It's basically the account categories that you have identified as posting every one of the expenses you incur gets included into one of these categories. And it's really important that as you set up your books or have your bookkeeper set up your financial statement format, that you think of don't have any more than about 15 categories. 12 to 15 expense categories is about all you need, because you want to include here items that you can actually manage. And because that's the purpose of an operating statement, is not only to see how you've done historically, but not just to see the numbers, but also to see the percent, because you can begin to manage your business. So you've got all of these expense categories, and one of the biggest expense categories for most businesses is going to be payroll. And so you get down here in payroll, salaries and wages, you get down in payroll, and if you have a column, you have the dollars here, and the next column over you have percent, and that's what percent is payroll of revenue. And so you know that that needs to be within 10, 15%, 20%, whatever your guideline is, and it's 25%, you know you've got a problem. It immediately alerts you, I've got to make a decision. I'm spending too much money on payroll. The other category where that tends to get out of whack is in marketing. Marketing, and usually for smaller and mid-sized businesses, it tends to be the opposite problem. It tends to be you're spending too little on marketing, or you're spending quite a bit on marketing, just doing what people told you that you should do, but you're not evaluating the impact of that marketing, whether it's doing you any good or not. So you're spending 6, 7, 8, 9% on marketing, but you're not getting the bang for the buck that you ought to get out of that. So you want to have a revenue column, and you want to have next to it a column that basically shows that as each of those expense categories as a percent of revenue. And so sales, cost of goods sold, gross profit, which is the money you have to operate your business. They collectively included in this illustration overhead, all of the operating expenses that you incur, as they call it, overhead. I just showed you a statement that's got that broken down into subsets, 12 to 15 subcategories that are really how you're going to keep track of things. And then the net profit, what you earn from the business. And so then the net profit is important, because the net profit pays for owner's draw. So if you're a sole proprietor, wait a minute. If you're a sole proprietor, the money, well, let me back up just a minute. So you can own a business in 4 ways. Your business ownership structure can be a sole proprietorship. It can be a partnership. It can be an LLC, limited liability company, or it can be a corporation. And a corporation's got subsets. It's got C Corps and S Corps. And so there's different ways in each of those structures. There's different allowances for how you, the owner of the business, get paid. And under a sole proprietorship, the amount of money that you're considered to have earned for the business. It is the amount of money that's left over after everybody else is paid. You do on your income tax, you do the schedule called a Schedule C. You work down to the bottom. The bottom shows a number, and then there's self-employment taxes that get taken from that number. And finally, there's this net number down there, and that number gets transferred to your 1040 form, your income tax form, and that's what you earn from the business. Now, granted, during the year, you may have done owner's draw and taken money out of the business, so you don't have to wait to the end of the year to take any money out of the business. But when it comes to just the actual accounting, that's the amount of money that's you are considered to earned from the business. And so a net profit all pays for future expansion and equipment, pays for a principal loan repayment, pays for income taxes, and one of the things about an operating statement, just a little kind of a quick little side note. So if you're just ongoing operating your business year after year after year, there's no intention to sell, then you want the taxable income of the business to be as low as possible. Within legality, the range of legalities, you want to pay as little income tax as possible. However, you need to change your thinking if you're intending to sell your business. So 2 years before you intend to sell your business, you need to change your bottom line philosophy, because one of the ways you value a business is on a multiple of the bottom line. So now, if you're intending to sell your business, you want your bottom line to be as high as possible, because it will show a greater value for your business when a multiple is applied to it than a lower number would. So just remember what you're driving toward when you do this. So that's a quick overlook at a P&L, and how do you compile a profit and loss statement? The easy, if you have business accounting software. Sounds like this is a commercial for business accounting software, and that's not the case. It's just illustration of how important it is to have good records and not be creating a program that requires you, the owner of the business, all day to sit there and input data into handwritten data into a program. One other option that you can do in the financial management tool, there's a program that Intuit does called Quicken, and Quicken is not Quicken doesn't prepare balance sheets, and it doesn't prepare cash flow forecasts, but you can prepare a P&L statement through Quicken. And Quicken is it's a record keeping system more than anything else. So basically you input data and you categorize it in the chart of accounts category. You can create your own, and you've got revenue and you've got expenses. So at the end of any particular point in time, you can also print out for yourself and have available for you a P&L to operate your business. So that's the end of the financial worksheet process, the financial statement process. So projections. One of the, most of you in your business, one of the head scratchers that you engage in before you start business is, how on earth do I project the financial performance of my business? And if you'll contact Ruth, I've got a booklet that I put together it's called Financial Management for Small Business, and there's a section in it. It's a handwritten, or not handwritten, but it's not a bound book. It's a book a booklet would be a better description. But in the back, there's a budgeting section, a budgeting chapter. And in the budgeting chapter, there's also spreadsheets, shows you some spreadsheets in there. And it will give you some illustrations on how to do a good budget and forecast. I'm using the terms interchangeably. And there's kind of a current hot term that people are using in budgeting and forecasting called rolling forecasts. And rolling forecasts basically you you have you do it in a spreadsheet kind of a format, but on the same spreadsheet, you have quarter one and quarter two history, and you have quarters 1, 2, 3, and 4 projected. So you have you have like up to 18 months of numbers shown on there, and each time a quarter concludes, you add a new reality quarter, and you add a new quarter in your projections. And the key thing about projections is to have a good set of assumptions, not just general assumptions like, I think my business will grow by 10%. That's my assumption. That's not assumption. That's basically a pie in the sky dream statement. If I were your consultant, for example, you and I would have a rather lengthy conversation so that we could drill down into what is it. Let's get down to the most basic thing we need to do to determine whether or not this business can grow by 10%, 20%, 30%, 40%. What is within our power to change and engage in to see that growth happen? Or is it even possible? Maybe the market, maybe we create a business concept and we look at the market, we look at different strategies, and we find out, hey, man, I can't find a strategy that'll enable me to do what I thought I was going to be able to do in the market. It's better to know beforehand that that's the case than it is to just throw a bunch of money and try to do a business and find out that from the get-go it wasn't a workable idea. So you want to always be in the projection forecasting business, because you'll see when you need to change. You'll be able to read the tea leaves on a lot of different things that'll be important to you. Thank you for the opportunity to present to you, talk with you about a topic that I love, that I think is the heartbeat of your business, financial management. Ruth?
Warren, we can tell that this is a passion of yours. So what would be the recommendations you give a startup? What recommendation you will give a company that is growing? And what recommendation would you give to a company that is ready to expand? Looking at the 3 different worlds of small business, what key element you'll tell to start, to grow, or to expand? The 3 different types of companies.
Well, so from a starting business standpoint, the key budgeting and forecasting is critical, and to have a good pro forma income statement that's got a solid base of assumptions around it is it's imperative. There's an online program that you can do called lifeplan.com, and LifePlan, it's not the only one. It's just one I happen to like because I use it a lot with my clients. And LifePlan enables you to do all of your forecasting. It'll actually create, from your forecasts, it'll create balance sheets and cash flow statements for you based on your assumptions. But that's critical from a startup business's standpoint. From somebody that's already in business, you want to the management tools afforded to you by all 3 statements. You want to be familiar, even though you may have somebody else prepare them for you and deliver them to you. You want to be familiar with your P&L and what it shows you, and have not just your P&L numbers shown, but have the percentage column next to the numbers that show what percent each of these expenses represent as a percent of revenue. And you want your cash flow. You want to keep your eye on cash flow, because cash flow is going to enable whether or not you can do what you want to do with your business. And if you're a growing business, the balance sheet is critical. So the balance sheet, because the balance sheet shows you the resources you have, well, the balance sheet and a cash flow statement, because they show you the resources you have and the resources you're anticipated to have within your reach this point in time to grow your business. And if you're like I have a business I'm currently working with that doubled from 10 million to 20 million in 1 year's period of time. And without being managed properly, without your finances being managed properly, things are just hectic and chaotic. You got employees that you got a whole bunch of new employees that you need to take care of the growth of the business. And so but the heartbeat, if you've got a good P&L that you keep your eye on, I mean a good cash flow statement you keep your eye on, and a good balance sheet that you keep your eye on, you're going to be able to see what resources you have to grow your business. Now that doesn't take into consideration all the other factors that growth businesses have to pay attention to, like the HR factors and strategy, because there's always somebody on. One of the reasons business is so exciting is because there's always somebody out there gearing up to eat your lunch. There's somebody out there right now, whatever business you're in, whatever business you're considering, there's somebody else, a group of somebodies, some cases a whole bunch of somebodies that are out there trying to tap into the same markets you're trying to tap into in a different way. And so strategy is critical. Anyway, I went on a bit on that, but hey, you got me rolling.
Excellent, excellent. I was gonna ask you something that we are planning. We're planning a workshop in March, and it's all regarding reconcile your account, because understanding from a bank standpoint, cash flow is king to make to analyze a company, but is reconcile something that it's crucial for a small business to take care of their numbers?
Well, you always want to be, yeah. I mean, you want to reconcile your accounts at the end of at the end of every month. There ought to be a reconciliation process that goes on, because when you get in a growth mode and and you get audited, for example. So you're in business, and at any point in time, if you're in business, if you give the IRS, or if you collect sales tax, the sales tax, the state of California, excuse me, sales tax, franchise tax board, to audit you, you want to make sure that everything is in order. So reconciling is critical to make sure that your books, your financial statements accurately reflect the copies of what you have in your files. When audits are done, that's the first thing that an auditor looks at, and it can be not just an auditor from that you pay an auditor, but auditors that come to make sure that you're doing what you're supposed to do. OSHA auditors, workers' comp auditors, all kinds of auditors that have a right to come and visit you. And for that reason, you want all of your records to be in order. You want your files to be accurately represent what's on your income statement, your full financial statements.
Wonderful. And something that I think it's important for small businesses in general is that we get to a point when a company grows that we just give everything to the bookkeeper, right? The bookkeeper is in charge of everything, and we might, because we're masters in what we do, so we dedicate and put all our efforts in sales and in developing the business and mastering whatever the type of business we have. And numbers sometimes is something that you just don't incorporate in your daily life. And knowing what's going on in your business is part of knowing your numbers.
Oh yeah, no, you got it. I always look at it like have somebody do. It's okay to have somebody do the books, input the data into your books, but you need to be regularly looking at and in touch with and know what they're telling you. That is so critical, because not to be overly dramatic about the whole issue, but if you don't keep your eye on your money, and somebody else is given the ability to handle your money in any way they want to, who knows how your money would be handled. So the way that you know how your money's being handled is by you keeping your eye on your financial management tools.
Definitely. Well, I want to thank you again, Warren, to taking the time and to going through so many details on all these financial statements that are so important for small businesses, and understanding what they mean. Um, you can follow Warren at LinkedIn. He has a very active account in LinkedIn, and he's usually writing documents and research and white papers in his LinkedIn account. And if you want me to send you the document that Warren is offering you, please contact me too, and you can do it through LinkedIn, or you can go to canterburybusinesscenter.com. We're going to go to the last slide, Warren, if we may, so we can talk a little bit about the Women Business Centers. So the California Women Business Centers are a program of the SBA. It's a federal program that is available not only for women, even though we target the women and minorities, but it's a program developed by the SBA to give you access to all kinds of services, workshops, and one-on-one consultations. Most of their services are free, so take advantage of this opportunity. There's 13 centers and we have here the map of California, so you can see where they are located. In Los Angeles, there's 2 centers, so take advantage of that. And they have a Facebook where they interact and give a lot of information. You can go back to their website, californiawbc.org, where you can find the addresses of these 13 locations. And in addition, you're going to be able to visit, to see all the coming webinars that are planned in the future. And all these are free resources for small business. So thank you so much for joining us. Thank you so much, Warren. I don't know if you want to say a few words to close the webinar.
No, well, I appreciate the opportunity, and go get them.
Absolutely. See you next time. Thank you so much.
All right. Thank you.
Bye now.
Bye.